Hey everyone, welcome back to Corporate Decode, the place where we uncover the hidden truths within these massive financial reports. And for Caterpillar's financial arm, they've been busy refinancing some serious dough, so buckle up. Today we're diving into Caterpillar Financial Services Corporation's latest, filing a document that lays out some pretty significant financial moves. Think of it like a company getting a fresh set of credit cards or maybe a whole credit line for its operations. It's all about how they plan to fund their massive machine operations and services around the globe. We're going to break down what these agreements mean for the company and what it tells us about their financial health. So pop some popcorn and let's get decoding. Also, if you're keen on cracking the code behind corporate finances, make sure you're subscribed, and hey, we've got a fantastic Discord community where we dissect these things further. Link is in the description below. So what exactly is this report about? Well, Caterpillar Financial Services Corporation, or CAT Financial as they like to call themselves, has essentially updated and extended its borrowing capabilities. They've put in place new credit agreements that give them access to a significant amount of money to keep things running smoothly. The main event here is that CAT Financial has entered into new credit facilities. Think of these like giant credit lines set up with a bunch of banks. These aren't for buying a new bulldozer for your backyard, but for the big picture stuff, running a global financial services company that supports a massive industrial giant like Caterpillar. First up, they've got a 364-day facility. This is essentially a short-term credit line that expires just shy of a year. They can borrow up to $3.5 billion under this. Now, why would they do this? Short-term facilities are flexible. They allow companies to manage immediate cash needs, fund ongoing operations, or even bridge to longer-term financing. It's like having a readily available cash buffer. They've also added local currency options to this. This means they can borrow not just in US dollars, but also in other currencies like pounds, sterling, euros, and Japanese yen. This is super important for a global company like Caterpillar. It helps them manage currency risks and makes it easier to fund their operations in different countries without having to worry as much about exchange rate fluctuations. They can borrow up to the equivalent of $100 million in these local currencies under this facility. It's also worth noting that this new 364-day facility is replacing an older one that was put in place just last year. This suggests they're keeping their short-term financing options fresh and updated to current market conditions. But it doesn't stop there. CAT Financial has also significantly updated and extended its longer-term credit agreements. They're talking about a 3-year facility and a 5-year facility and a 5-year facility. The 3-year facility agreement, which was originally set up back in September 2022, has been amended and restated. This means they've basically rewritten parts of it and extended its life. The key takeaway here is that this facility now extends its availability until August 28th, 2028. That's pushing out its expiration by 3 years. Under this renewed agreement, they have access to up to $3 billion. Similarly, the 5-year facility, also originally from September 2022, has been updated and extended. This one now stretches out to August 28, 2030, making it a 5-year commitment from its new expiration date. And this facility gives them access to an even larger sum, up to $5 billion. So in total, they have access to a massive chunk of change here across these different facilities. The 364-day facility gives them up to $3.5 billion. The 3-year facility provides up to $3 billion. And the 5-year facility offers up to $5 billion. That's a lot of buying power, an enormous amount of flexibility to fund their global operations. What are they using this money for? Generally for corporate purposes. This is pretty standard. It means they can use these funds for anything from day-to-day operations, investing in new equipment, expanding their service offerings, or even strategic acquisitions if the opportunity arises. Interestingly, as of the date of this filing, they haven't actually borrowed any money under these new facilities. This doesn't mean they won't. It just means they have the option available to them. Companies often set up these credit lines as a safety net or to ensure they have funding readily available for future needs. Now, like any good loan agreement, there are strings attached. These credit facilities come with pretty standard but important conditions and commitments. They include things like making sure the company is financially sound. For the parent company, Caterpillar Inc., there's a requirement to maintain a consolidated net worth of at least $9 billion. Net worth, in simple terms, is what the company is worth if you add up all its assets and subtract all its debts. Keeping net worth above this level is a sign of financial stability. For CAT Financial itself, there are specific financial ratios they need to keep an eye on. One is the interest coverage ratio. This ratio shows how easily a company can pay the interest on its outstanding debt. They need to maintain this ratio above 1.5 to 1. This means their profits before interest and taxes should be at least 1.15 times to 1. This means their profits before interest and taxes should be at least 1.15 times to 1.0 their interest obligations. Another key one is the leverage ratio. This measures how much debt a company has compared to its net worth. Cat Financial needs to keep this ratio at 10 to 1 or lower. So for every dollar of net worth, they can have up to $10 in debt. This is a significant amount of borrowing power, but also indicates they are leveraging their assets heavily to fund growth. These covenants are crucial. If Cat Financial or Caterpillar were to breach these financial requirements, it could trigger serious consequences, potentially leading to default on the loans or much higher interest rates. It's a reminder that having access to credit comes with responsibility. It's also common in these big financial deals for the banks providing the loans to also offer other services to the company. So the same banks that are lending money might also be giving investment advice or helping with other financial transactions. This is pretty typical and represents another layer of business for these financial institutions. And then we get to the exhibits. These are the actual documents that detail these agreements, all the fine print. The filing lists out all the credit agreements, the local currency addendums and the Japan local currency addendums for both the 364-day facility and the expanded 3 and 5 year facilities. It's essential for anyone wanting the nitty-gritty details, but for us today, understanding the scale and purpose of these facilities is key. Finally, at the end, you have the signatures. This is where the authorized personnel officially sign off on the report, confirming everything within it. In this case, it's signed by James M. Rooney, who serves as the secretary on behalf of Caterpillar Financial Services Corporation. This is the formal stamp of approval. So what's the big picture here? Caterpillar Financial Services Corporation has secured massive credit facilities. The total available credit here is substantial, running into billions of dollars across different timeframes. This shows a strong need for flexible financing to support Caterpillar's global operations. My take on this is that Caterpillar is proactively managing its financial structure by extending and refreshing these credit lines, especially with the inclusion of local currency options. They are demonstrating a strategic approach to funding. The financial covenants, while demanding, are within the realm of what's expected for a company of Caterpillar's size and scope. They are essentially preparing for continued investment and operational expansion. One potential risk, as highlighted by that 10 to 1 leverage ratio for Cat Financial, is that they are using debt significantly to leverage their capital. While this can amplify returns when things go well, it also increases risk if market conditions turn south or if their repayment abilities are tested. Overall, this filing paints a picture of a well-oiled financial machine that is ensuring it has ample resources to fuel the growth and operations of the broader Caterpillar enterprise. They are borrowing heavily relative to their net worth, which is a strategy that needs careful monitoring, but is often employed by large corporations to maximize capital efficiency. It shows confidence in their future earnings and cash flow generation to serve and employed by large corporations to maximize capital efficiency. It shows confidence in their future earnings and cash flow generation to service this debt. That's our deep dive into Caterpillar Financial Services Corporation's latest filings. What are your thoughts on these massive credit facilities and what they mean for the company? Let me know in the comments. If you found this breakdown helpful, smash that like button and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description. It's the place to be for more financial decoding. Thanks for tuning in. See you next time.